Okay, this is what we went over in chapter 15 for the participation points because people were kind of confused about the T accounts. So I put them into journal entries that you should do first. So let's look at this. What do we have? The entries would be required to complete the delivery of job A40. So first of all, what do we have? Well, it looks like it costs $10,500 and it's going to go into transfer. Oh, well, this one says transfer to work in process. We're talking labor and materials and factory overhead. And that is not over here. If we were to have that over here, it would be a debit to work in process and a credit to materials. So if we do the second one, we're going to transfer that work in process to finished goods. And that's going to become a credit to work in process. And we're going to put it into finished goods. So that sets up the finished goods. And that looks like this in a T account. Here's the credit that makes this 0. And we're going to move that to finished goods. And there's the debit with that. Now we sold it. So we're going to record the sale. So that involves a cash sale of 14,900. And I have the wrong account there. There should be sales. And let's see if I can mess it up anymore for you. So now we have cash receiving 14,900 and sales increasing by 14,900. So there's the increase in sales and there's the increase in cash. Got that. Now we've got one more, right? We've got to record the cost of goods sold. And that cost of goods sold is actually the work in process that was transferred in here. So our cost of goods sold gets hit for 10,500 and our finished goods gets hit for 10,500. And that makes it nice and neat. So to watch the flow of this through the factory or through the T accounts is what I was really wanting to have happen here. So this is the transfer in of materials. When it's complete, it gets transferred to finished goods. When it gets sold, it gets taken out and put into cost of goods sold. And this is recording the sales here. So you can see how it flows. Now all of these up here end up being 0, and this would eventually. So this acts as a sort of a closing entry, an adjusting entry to get everything closed into the cost of goods sold, which then gets put into the income statement, which then gets closed out at the end of the period. So all of this is just a transfer of costs, putting it in the proper location and keeping track of the materials and the labor that's used. So that's kind of what we were shooting for here. Exercise 2, same thing, only now we've purchased material, and so this is 50,000 here and 50,000 here. That sets up this purchase, and then we used indirect material, and indirect material gets put into factory overhead. So that sets that account up. And then we use direct material. So we're going to have to remove it out of direct material with a credit and put it into work in process. Now eventually this factory overhead is going to get there also, right? So let's see what this looks like in T accounts. So here's our raw materials inventory. We bought it. Here's our cash entry. where we credited it. See that? And now let's look at factory overhead. This is where we've removed it from the inventory and put it into factory overhead. And this last entry is where we've taken the direct materials and put it into work in process. Now, eventually you're going to have, this is actual inventory, actual factory overhead, and this is applied. So when we get all done with all of our adjusting and everything, you're going to have applied, and let's say it's 13,000. We've applied that through distribution, direct distribution and estimating. And now you come up to this, and now you're going to have to transfer this factory overhead and get this to be 0. And we're going to show you how to do that in the next one. So remember, actual is the debit and applied is going to be the credit for factory overhead. I hope it's getting better. And now we are looking at payroll. We're going to do the same thing. Now, in 101, we did payroll payable, right? And that was a credit for 180,000. And then we just did wages expense. This would have been wages expense, and this would have been supervisory expenses, or salaries actually. So this would have been wages and this would have been salaries as we looked at it. But now we've changed that. So you've done this before, we just had different names. Now the wages, just doesn't want to stay there. Now the wages are called work in process, and those go to cost of goods, or cost of goods manufactured. And the salaries are called factory overhead or indirect labor, and they go into factory overhead. So this says my indirect labor is 40,000, and my direct labor is 140,000. So that's our journal entry, and this is what it looks like in T accounts, the flow. You'll see a debit there and a debit there. Again, this is actual. There may be an applied here to be compared to. So you kind of get the idea of how to do this now. So you have to, I think, probably be easier for everybody to do the journal entries first. I was thinking it would be easier to do T accounts, but I was wrong. So here's where we're going to learn how to do estimating. And so we're estimating what the factory overhead is, and we're looking for an overhead rate to apply this with. So in this case, we're saying, okay, for every direct, we're estimating we have factory overhead of 117,000. We have direct labor of 468,000. And we're going to use the direct labor as an activity base to figure out our overhead rate. So I'm going to divide that estimated factory overhead by the labor dollars and find out that for every dollar I spend in direct labor, I'm also going to apply 25 cents worth of factory overhead. So if I had $500,000 in direct labor that month, I would apply 25% also to factory overhead. And that's where that applied factory overhead comes from. Because we don't know what the overhead's going to be in advance, we estimate it and apply it throughout so it can build value. Now, if I decide to use direct materials, it's the same process, only I'm going to come up with a different overhead rate. It would depend on which one of these is most consistent and which one shows the best numbers for what you're looking for. And here we're doing payroll entries to apply factory overhead. And in this case, we've got a payroll of 175. I have indirect labor of 144. I have direct labor of 131. And it's saying the factory overhead is 90% of that $131,000. So what I do is take that $137,000, multiply it times 9, and come up with 117,000 estimated factory overhead, or we call it applied overhead. Now, what do you do with that? Well, since I want to apply that and find out what how my costs are running, this is what you end up doing with this whole scenario. See, first of all, you're going to apply the payroll. So let's just look at the payroll. So the payroll is 175, and it splits out to be 44,000 in work in process as a debit and 131 for your direct labor. Now I've got to come back and I have to get my factory overhead in there. And this is how that looks, because now you're going to increase your work in process by 117,900, and you're going to credit the factory overhead for applied, this is applied, for 117. So now if I say how much money do I have wrapped up in the work in process, this job right now, all I can do, I can go in there and I'd have a fairly good idea of the cost involved in that product that I'm creating or developing or getting ready to ship out. Now, I may come back and at the end of the month find out the actual overhead was 120,000. So this is actual, which would be applied, and then, or would be recorded, and then you would compare the two. You'd find out this is what I have in my work in process, but this is how much I've really spent in factory overhead. So I'm going to have to get this to 0 at the end of the period. So the difference between this and this is going to be recorded into cost of goods sold, because that's where it ends up at. And we'll do one of those. So I think I will stop here and load this up for you so you can do a walkthrough on it. I'm hoping this is helping.